Have you ever paused when you tap your phone for a coffee or send money quickly online and wondered how safe your cash actually is? In this super fast digital world we live in, where money moves instantly, the trust we put in these payment services, well, it's everything, isn't it? And the security, even more so. Today, we're doing a deep dive into some really crucial updates from the UK's Financial Conduct Authority, that's the FCA. These updates, they're all about how your funds are looked after, safeguarded by payment providers and e-money places, basically making sure your digital wallet is, properly locked down.
Exactly. And for this deep dive, we've really drilled down into the essentials from the FCA's policy statement, PS 2512. Think of that as their latest rulebook for better protection. It details some big changes to safeguarding under PSD2. Oh, and PSD2, just quickly, is the Payment Services Directive. It's kind of the main set of rules for digital payments across the UK and Europe. We've also gone through their big approach document for payment services and e-money. These are, well, they're the foundation for what we're discussing.
Right, the core documents. And it's really important to mention that all this fantastic source material, the basis for our chat today, was kindly supplied by Compliance Consultant, home of the compliance doctor. So our plan is to cut through the jargon, give you the key bits so you understand not just what's changing, but crucially, why it matters for you personally. Okay, let's get into it. So let's jump straight in then. Why now? Why these big changes at this particular moment? What weaknesses did the FCA actually find?
Well, the FCA's findings are pretty stark, actually. They found some payment firms just don't have strong enough safeguarding practices. Simple as that. And this isn't just, a minor admin issue. They stated it presents an unacceptable risk of harm to consumers and market integrity. That's strong language from a regulator.
Unacceptable risk.
Yeah, think about it. If your money isn't properly ring-fenced by the firm holding it, and that firm, say, collapses, well, your funds could be tied up for ages or worse. So the main goal here is to really minimize any shortfalls in that protected money. Make sure that if a firm does fail, customers get their money back quickly and cost-effectively. And it's also about giving the FCA stronger teeth, more power to step in early if things look shaky.
That makes sense. Unacceptable risk of harm. It's not just about a couple of bad apples, is it? Because we're seeing this huge shift in how people manage money day to day. I mean, look at the numbers. The percentage of people using these payment accounts went from just 1% back in 2017
Tiny.
to a massive 12% in 2024. What does that kind of explosion in usage mean for the level of risk we're talking about?
It ramps it up massively. The potential for widespread consumer harm is now huge. If a large firm with weak safeguarding failed, the domino effect could be devastating for, well, potentially millions.
Okay.
And what's really concerning is the impact on vulnerable consumers. The FCA's own research, the Financial Lives Survey from 2022, found that 40%, 4 out of 10 e-money account holders, had at least one characteristic of vulnerability.
40%? That's huge.
It is. And these are often the people who rely most heavily on these digital services for everyday stuff, paying bills, getting benefits, managing tight budgets. So protecting them isn't just important, it's absolutely vital.
So the stakes are incredibly high. It's not just individuals losing out. If one badly run firm goes under, it could really damage trust and confidence across the whole sector.
Exactly. Undermine market integrity.
Okay, so if the risks are that big, who exactly are these new rules aimed at? Who's on the hook here?
Well, the net's cast pretty wide, actually. It primarily covers most authorized payment institutions, though there are a few specific exceptions we don't need to get bogged down in.
Yeah.
Also authorized e-money institutions, the small e-money institutions, and even credit unions if they issue e-money in the UK.
And you mentioned exceptions, but there's also this voluntary bit for smaller players, right?
Yeah.
Small payment institutions, SPIs. They can choose to comply.
That's right. SPIs can opt in to the safeguarding requirements. And it's similar for small e-money institutions and credit unions when it comes to payment services that aren't related to their e-money side.
It does make you wonder, doesn't it?
Yeah.
If it's voluntary, does that leave a gap? Or will market pressure sort of push them towards adopting these higher standards anyway?
That's a good point. It's a balancing act for the FCA protection versus proportionality for smaller firms. But it's not just the firms themselves who are affected. The impact ripples outwards. Obviously, consumers, consumer groups, they're central. But think about insolvency practitioners, IPs, the people who have to sort out the mess if a firm fails.
Right, they need clarity.
Definitely. Auditors, too, who check compliance. Professional advisors, lawyers, accountants dealing with these firms. And even the banks or institutions providing the safeguarding accounts themselves, or the custodians holding the assets, or those offering insurance or guarantees. They're all part of this ecosystem and feel the effects.
It really shows how interconnected it all is.
Yeah.
So, bottom line, whether you run a business using these services, advise clients, or just use payment apps every day, these changes are ultimately there to protect you, to build that trust.
Okay, so we know who's involved. We know why it's so urgent. Let's pull back the curtain now. How exactly is the FCA planning to make this protection happen? What are the concrete changes?
Okay, so the FCA is putting in place several key pillars of protection, as you might call them. First up is enhanced monitoring and reporting. The big thing here is new annual audits for certain firms. Specific authorized payment institutions and e-money institutions will need an independent, qualified auditor to check their safeguarding compliance every year. An external checkup, basically. That sounds pretty significant. Does every single firm have to do this, though? Even tiny ones?
Good question. No, there's an exemption. If a payments firm hasn't had to safeguard more than £100,000 at any point over roughly a year, 53 weeks is a specific period they're exempt from this annual audit.
Okay, so that helps the smaller end.
Exactly. It's pragmatic. But alongside the audits, all firms now need to submit a new monthly regulatory return to the FCA about their safeguarding.
Monthly. Wow, that's frequent.
It is. It means the FCA gets a much closer, near real-time view, not just a once-a-year snapshot. Then the second pillar is strengthening safeguarding practices directly. This is about the nuts and bolts. A key part is the segregation of funds. Firms need to show more skill, care, and diligence when picking banks or others to hold safeguarding accounts. They also have to review these arrangements regularly and think about diversifying, not putting all their eggs in one basket, so to speak.
Makes sense. Avoid concentration risk.
Precisely. And a really crucial operational point. Funds they receive for e-money, like your digital wallet balance, must be safeguarded separately from funds received for other unrelated payment services.
Wow, so no mixing.
No mixing. Separate pots, separate reconciliations. It makes it much clearer where customer money is and what it's for. Now, firms can still invest safeguarded funds, but only in secure, liquid assets. The FCA has provided clearer guidance on what qualifies, so no risky ventures with customer cash.
Okay. What about using insurance instead of segregation?
Good point. Insurance and comparable guarantees are still allowed, but the rules are much tighter now. The policy must pay out promptly if the firm becomes insolvent, with basically no conditions attached except confirming the insolvency itself. No wriggle room, no delays.
That sounds critical for getting money back fast.
Absolutely. And firms using insurance have to decide at least 3 months before the policy expires whether they'll renew. If not, they must have a plan ready to switch immediately to the segregation method. No cliff edges where protection suddenly drops off. And finally, there are new requirements around resolution packs. These are like an emergency toolkit for the firm.
But what to do if it all goes wrong, manual?
Kind of, yeah. It's a collection of essential info needed super quickly in an insolvency. The new rules make sure firms actually have these ready and up to date, so if the worst happens, the process of finding and returning customer funds is much smoother.
Okay, that covers a lot of ground. But new rules, tighter controls. That usually means costs for businesses, right? What's the bottom line on that? Did the FCA figure out the cost versus the benefit?
Yes, they did, and you're right to ask about costs. The FCA got feedback that their first estimates for audit costs were a bit low, so they've revised them upwards. The central estimate for these new costs for payments firms is now around $53.3 million, up from $49 million initially. So, yeah, it's a significant cost to the industry.
$53 million, okay. But the benefits?
Well, here's the flip side. Despite those higher costs, the FCA's overall analysis still shows a positive net present value NPV over 10 years. Their central estimate is $64.3 million, and the expected benefits, things like reduced consumer harm, avoiding market disruption, building trust, they still estimate those at a hefty $137.5 million.
So the calculation is that the benefits significantly outweigh the costs, even with the higher cost estimate.
That's the FCA's conclusion, yes. They see it as a necessary investment for a healthier, safer market overall. And practically speaking, they've said they'll engage with industry to support implementation. They've also extended the deadline for putting some rules in place and for submitting that first audit, acknowledging it's a big lift for firms.
Right, giving them some breathing room. And didn't the source material mention something about compliance consultants playing a role here?
It did, yeah. It noted that many firms are actually using compliance consultants to help them get these safeguarding audits done, which makes sense. It's complex stuff. And interestingly, the FCA factored that trend, the cost of using consultants, into their revised cost modeling.
That's interesting. Okay, so audits, segregation, costs. What else is in the FCA's broader approach here? Are there other key areas firms need to focus on?
Definitely. The approach document covers more ground that reinforces the safety net. For instance, authorization and capital. Before a firm even gets off the ground, there are initial capital requirements. Like an authorized e-money institution needs to hold $350,000. Now, this isn't just money sitting there, it's a buffer.
A cushion against losses.
Exactly. A buffer against unexpected losses, helping ensure the firm is financially sound from day one and can weather storms. Then there's the suitability of management. This is crucial. The FCA needs to be satisfied that the directors and main controllers, anyone with significant influence or earning 10% or more, are fit and proper.
Fit and proper. What does that actually mean in practice?
It means they look closely at their honesty, integrity, competence, financial soundness. Are these the right people to be responsible for managing other people's money? It's a serious check. Next up, risk management and wind-down plans. Firms need rock-solid procedures to spot, manage, and report all kinds of risks, operational, liquidity, you name it. And they absolutely must have detailed wind-down plans. These are the firm's exit strategy, basically. How do they shut down in an orderly way if they have to?
Right, not just collapse in a heap.
Precisely. And critically, how do they quickly identify and return customer funds during that process? It's all about preventing chaos and protecting customers even when a firm closes. And of course, there's financial crime. All these firms have to comply strictly with anti-money laundering AML and counter-terrorist financing rules. We're talking about the MLRs, POCA, the Terrorism Act. And the buck stops with the firm. Even for what their agents or outsourced providers do, they can't pass the blame.
So a tight grip on preventing illicit use.
A very tight grip. And finally, something users might actually see more directly. Strong customer authentication, or SCA. This kicks in when you do things like log into your account online, make an electronic payment, or do anything remotely that might carry a fraud risk. The key is needing 2 or more authentication factors. That combination of something like a password, something you have, like your phone getting a code, or something like a fingerprint.
That extra security step.
Yeah, that extra layer to make sure it's really you making the transaction, not a fraudster.
Okay, wow. So putting it all together, what does this really mean for the person listening, whether they're just using these services day to day, or maybe they work in finance or advise businesses?
It means a really significant push, a systemic effort towards much higher standards. More security, more transparency, more resilience baked into the digital payment system. It's reinforcing the idea that your money isn't just some number in an app. There are serious, robust, and constantly evolving rules working behind the scenes to protect it.
It's certainly a lot to take in. This deep dive really has shown the lengths the FCA is going to bolster how our funds are protected in this fast-changing digital money world. From those mandatory annual audits and the monthly check-ins to the really strict rules on separating funds and ensuring insurance actually pays out, the goal seems crystal clear.
Yeah, protect the money, ensure firms are ready for anything.
And the commitment to reducing harm, especially for those vulnerable customers we talked about, that really comes through strongly.
He does. And even though there are definite costs for the firms involved, the FCA clearly believes the bigger picture benefits market stability, consumer trust, make it worthwhile. It's building that stronger foundation.
It really underscores how financial regulation has to keep moving, keep adapting to protect us all as technology races ahead. And just a reminder, this incredibly useful deep dive material was supplied to us by Compliance Consultant, home of the Compliance Doctor. If you're trying to get your head around these complex regulations, or maybe your business needs guidance on compliance, you can find out more or book a no-obligation discovery call with them. Just visit their website, https://complianceconsultant.org. That's complianceconsultant.org. Or you can email them at info@complianceconsultant.org. If you're in the UK, you can call them too, 0800-689-0190. And there's a direct link for scheduling a call, https://bit.ly/discover. That's bit.lo/C D ISCOVR. And get this, they're offering new client bonuses worth over $9,999 plus GBP, plus a 25% discount for all of 2025 to celebrate their 25th anniversary. Some great offers there. So, thinking about all these layers of protection we've discussed, it does leave me with a final thought. As technology keeps changing how we deal with money faster and faster, how do regulators, like the FCA, keep finding that balance? That balance between bulletproof security, which we all want, and the seamless instant transactions that we've all come to expect. What stands out most to you about these changes we've talked about today?